Hi, let's talk about homeowners forms. My name is Abahi and I am a claims adjuster. If you're wondering why am I making this video? Well, I recruit for insurance roles. So if you're looking for a job in either insurance or specifically claims adjusting, I will be the one to help you. I also am an approved provider for the property and casualty course. So if I'm not able to help you get work, I'm at least able to help you get a job. So today we're going to be talking about the homeowners coverages. You need to know this not just for the test, but you need to know it for work. We deal with homeowner coverages all the time. Yes, I don't just recruit, but I also work as a claims adjuster. Okay, so what's covered by the policy? Your coverages, your homeowners forms. You have four in section A. We will go over section 2 in a different video. Coverage A is going to be your main dwelling. So think of the four walls of your home and your roof. Oh, by the way, if you are watching this to take a property and casualty test, be sure to listen to this more than once. Repetition is the key, and the other key is to get the job done in 30 days. Don't wait more than 30 days from the first day you study to when you take your exam. It's proven and research shows the quicker you get the information in you, the better you do in your test. Coverage B is other structures. That's going to be the coverages or the properties outside of your main dwelling, your fencing, in-ground pools, sheds. I guess people have gazebos, barns. That's on the test is usually 10% of coverage A. That is usually 10% of coverage A. Now, in our course, we give examples, but for now, if you're looking at, hey, I got this test coming up and you want a quick brief, this is it. Your coverage C is going to be your personal property, which is the contents that you brought into the home. That is means if you turned your house upside down, everything that falls out is considered contents, and contents is what it personal property is covered by. That's coverage C. And then for coverage D, you have loss of use or your fair rental value, which pays for many, many things. And again, we'll go over that deeper into the actual course. Now let's go over the homeowner coverages and examples so you can see what this is like. Again, coverage A is your four walls of your home plus your roof.
So starting off with dwelling A, that coverage is pretty basic. It's your house. It's the physical location. It doesn't insure land, so insurance will never touch the land portion of it because there's no way to value that on an insurance portion. So dwelling A consists of the physical building, the walls, the exterior, the interior, the roof. There's a couple times where pieces are added onto the home like a deck, and that's bolted on, just like a car. If anything's bolted onto a car, that's considered part of the vehicle. With homeowners, that's the same exact scenario. Dwelling A is including a deck, a porch, anything that's connected, the concrete patio, even though it might not be directly touching, unless there's a several foot gap, they're going to consider that dwelling A. Now there's a couple ways that companies calculate this. Not to pull you out of the series, but save the link up here if you guys want to go over what's called actual cash value versus replacement cost. We're just going to talk about the replacement cost portion of it because this is how you determine what your dwelling A should be. This is the replacement cost of your home. It's pretty simple to do. I'll put a link below to a company that I'm not affiliated with, but they give kind of averages of home replacements and home values across the state. Not necessarily the value of your home. So we're not talking about if you sold your home, that's the value. We're talking about the replacement cost. How much is the lumber? How much is all of the materials to rebuild your house? If it's brick, how much does it cost to pay a guy to lay the brick, set a brick, lay it, set it, that stuff. It also includes demo. So if the house was a total loss and they had to take parts of it away, they're gonna get a charge, or you're gonna be charged to have somebody take all that material away, dispose of it correctly, and then now there's all of these updates. So you've got these different codes that when your house was originally built, they may not meet the codes today. So you've got that dwelling replacement cost amount. And what we're gonna do is we're gonna calculate one. So I'm in the state of Michigan. The average cost to replace a home in our state is $150 per square foot. If you go to that website below, they're going to show you, you can type in your zip code and it'll show you what your range is. It's usually, on average, I'd say across the US in my experience, it's $102 to $150 per square foot. Now I know Michigan is in the above average cost to replace, but it can go way beyond that. You can be in the $200 to $250 per square foot. It just depends on the materials of your home. So if you have columns on the outside, if you have bay windows, you've got jacuzzi tubs, you've got special roof material where it's called architectural shingles, where you've got all of these upgrades to the home, that's going to increase that cost per square foot.
All right, let's go on to coverage B. Remember, your coverage B is 10% of your coverage A. So that is your detached garages, any outbuildings, that is also in-ground pools, fencings, anything that is not connected to the house but is on the property. That is going to be on the exam. Coverage C, just remember, if you turn your house upside down, the material that falls out, all of that stuff, your junk, that is coverage C. Let's see what else you can learn about coverage C here.
Whether it's a collection of baseball cards or your grandmother's pearl necklace, your possessions are priceless to you. Most of us own some type of valuable personal property. However, your standard homeowner's policy offers only limited coverage, if any, for the protection of these valuables. For example, let's assume that heirloom pearl necklace is stolen. A standard homeowner's policy limits the maximum amount that is available to reimburse you for a loss by theft of jewelry items. In fact, the standard homeowner's policy only pays up to $1,500 in coverage, and that's not even considering any policy deductible you would have to pay. If the necklace was valued at $10,000, you're going to be underinsured by several $1,000s. So how do you make sure that you are adequately covered for your important collectible or valuable possessions? Take inventory of your possessions. Write down or take pictures of the items and note their value. Get an appraisal from a qualified professional and have your appraisals updated periodically, as the value of some items may change over time. Requirements for appraisals usually differ by insurance company based on value and the type of item being insured, but an appraisal can speed up the claims process by helping your claims representative more efficiently determine the value of your items. When working with your independent insurance agent to insure your home, be sure to include a review of your important collectibles and other higher valued personal property possessions. This will help your agent recognize any coverage restrictions you may have. Talk to your agent about scheduling your higher valued possessions or collectibles on a scheduled personal property endorsement. This is an endorsement that's attached to your homeowner's policy and provides you additional coverage to ensure your possessions are adequately covered should you suffer a loss. Although there is an additional charge, the endorsement provides broader coverage, and in most cases, there's no deductible. While many of your collectible or valuable personal possessions are irreplaceable to you, don't find yourself without coverage should they be lost, stolen, or damaged. Ask questions, take notes, and talk to your independent agent to be sure you have enough coverage for your valuables.
All right, great. We think I have a claim I'm working on for a homeowner down in near Savannah, Georgia, who has Central Insurance. Now, what they said is important. You do need to talk to your agent about having the right amount of insurance, but they're always going to be biased. You should have an unbiased party like a public adjuster assist you. In any event that you have a claim and you want to be paid out the max, never call your agent, never call your insurance company, call a public adjuster. Their job is to help you maximize the claim. Plus, you're just learning this yourself. You want to get an expert just like you would if you had a medical procedure. Now, here are some exclusions from property: your animals, aircrafts, vehicles, boats, paper and electronic data. Sometimes they can consider even that being your computer, that is electronic data. You also have credit cards and debit cards, money up to a certain point. There is a certain amount that you can get. And when you have a public adjuster, they assist you with that. When you have grave markers, because it's on land, that's not covered. And then water or steam. So if you have some type of water, maybe features like the water wouldn't be covered, streams wouldn't be covered. Okay, now let's move on to coverage D. This is the fourth part of section 1. There are 2 sections. Again, we go more over sections 2 in a different video. Loss of use means that you will not be able to stay in the home due to a covered peril. That means that you are not able to maintain your reasonable living condition. It also covers much, much more. And so if you've ever dealt with having to be outside of your home because there was damage in your home, there is help for you beyond just paying for a hotel. In fact, they owe you for the like, kind, and quality. And when I say they, I do mean the insurance company. For the test, you want to know that when your home isn't habitable, you want to be able to exercise your ALE costs. They also cover things like food when you're out of the home. So if you're in a hotel, they'll want to be able to cover your food. Let's take a look at a family that needed some homeowners coverage D.
Hi, it's me, Penny. We are placing the focus on Coverage D. Coverage D provides coverage for the additional living expenses incurred as the result of your home being deemed uninhabitable due to damage sustained from covered peril. In the event you are displaced from your home, Coverage D will provide assistance for temporary residence, moving expenses, storage fees, transportation fees, and other expenses associated with your family being temporarily displaced. A policy from Florida Peninsula affords you the peace of mind knowing should you be forced to leave your home while repairs are being made, your expenses will be addressed and your family can resume normal day-to-day activities.
If you're still watching this video and these videos in between are helpful, please let me know in the comments below or just give the video a thumbs up, a like. If you own several properties, maybe you're a real estate investor, you want to pay very close attention to this coverage because if you had a covered loss, in one of your properties, you're going to want to make sure you get compensated fairly for the lost rent. And this is what your fair rental value will do for you.
Hi, I'm Lee Siegel, and I'm the investment property specialist here at Integrity Personal Insurance. Today's topic will cover an important endorsement for your investment property called fair rental value. The simplest way to describe this coverage is if your rental property suffers a loss that is covered by the policy and the house is made uninhabitable for your tenants, this reimburses you for lost rent. So why is it important to you? Well, what would happen if your property suffers damage from a fire and your tenants have to seek alternative living quarters during the repairs? You still have to make your monthly mortgage payment, and without a tenant living there, your investment income is disrupted and you're losing money every month. If you do have the fair rental value endorsement, how much will you get? Well, the actual amount you will be reimbursed for will be adjusted by subtracting any expenses that do not continue while the home is undergoing repairs. Let me give you an example. Let's say you charge your tenants $800 per month, but because of the loss you have to shut off a utility such as gas or water while the repairs are being made. If those utilities normally cost $100 per month, instead of the full $800, you will be reimbursed $700 from the insurance company. And how long will you receive payment for this coverage? In general, it's the shortest time required to complete the repairs up to a maximum of 12 months. The actual length of coverage will vary by insurance company, so make sure you know the limitations on your policy. As far as the dollar amount that you can recover, that amount in most cases is 10% of the dwelling value. For example, if the property is insured for $150,000, then the fair rental value limit is $15,000. The cost to add this endorsement fluctuates with the dwelling value, so the higher the value of the property, the more the endorsement will run. But the average cost to add the coverage is around $40 to $50 per year. There's no deductible that applies to the fair rental value. In closing, the reason you are investing in rental properties is to build wealth and create passive income streams. The fair rental value endorsement helps you keep that income stream from being interrupted by an unexpected loss, making it an important coverage to add to your policy. Thanks again for watching. I'm Lee Siegel. I'll be back with another video real soon, so be sure to.
All right, as he was stating that it's no deductible. Well, if you have, it's only going to apply if you have a covered loss, which means you're also going to have repairs. So the deductible will be on the repairs. Now, each coverage does have a limit, and you should know that. You'll want to learn how to read a declarations page, which we help you do for free. So you can contact us, and if you want us to show you how to read a policy for free, just bring the policy and we'll help you do that. Now, let's go over what your homeowner policy limits are, because this type of information will be on the test,
Meet
so pay
Emily.
close attention.
Emily is in the process of buying a house in the suburbs. Emily has just watched our 2 videos, Mortgages 101 and How to Find a House and a Mortgage, so she knows exactly how to get a great home with great financing. However, she still has no idea how to get homeowners insurance. What should she do? Well, her first step is simple. Before she can buy homeowners insurance, she'll need to understand it. So let's start there. Like most types of insurance, homeowners insurance reduces the costs associated with a risk, in this case the risk of your house being damaged or someone being injured on your property, in return for a monthly fee called a premium, which is based on everything from your home's age to its location. As for how homeowners insurance actually works, it operates through 6 coverages bundled together, none of which are required by law, though all of them will be required by your mortgage lender. The first coverage is dwelling coverage, and it protects the structure of the home from theft and pretty much every disaster you can think of, except floods and earthquakes, whose plans need to be purchased separately. So how does dwelling coverage work? Well, in general, it works through a deductible and a limit. A deductible is simply the amount of money Emily must pay per incident before her insurer pays the rest, while a limit is the maximum amount an insurer will pay. For example, let's say Emily's insurance plan has a $5,000 deductible and her house recently suffered a fire that caused $100,000 in damage. Under the terms of her policy, Emily only has to pay the first $5,000 of this bill. Her insurer will cover the rest, up to a limit, say $500,000. So that's how dwelling coverage works. The next 3 coverages also work through a limit, typically as a percentage of the dwelling coverage. Let's go through each one. 1. Other structures on your property coverage, which covers things like outhouses and detached garages. 2. Personal property coverage, which covers the cost of replacing the contents of your home. And 3. Loss of use coverage, which covers any expenses you incur while your home is uninhabitable, such as staying in a hotel. Finally, the last 2 coverages operate a little differently. Their limits are standalone, independent from dwelling coverage. Again, let's go through each one. 1. Personal liability coverage, which protects you against lawsuits filed by those injured on your property. And 2. Medical payments coverage, which covers the medical expenses of those injured on your property who don't sue you.
So I hope that was helpful for you. He did go over in that final part coverage E and F, and those are the sections I was telling you we do in a different video. That is under section 2. The ones that you should be concerned for section 1 are A through D. Okay, let's do a quick quiz. Loss of use, which coverage is that under? That's what you have to do for each of these. Which coverage is under detached structures and which coverage covers other structures? Okay, let's fill these in. If you need more time, go ahead and pause this video. Your loss of use is going to be under coverage D. Remember, your coverage D could also be fair rental income for landlords or dwelling policies. Okay, so you have both there. Coverage D, it could be considered either loss of use or it can be considered fair rental income. Your detached structures, which coverage is that under? Coverage B as in Bravo. Coverage B as in Bravo. On the test, your coverage B is usually 10% of coverage A. 10%. Now, your last one here is other structures. What's that covered under? A little bit of a trick question here, but not really. Coverage B, other structures or detached structures could be considered interchangeable. And again, it's that 10%. Now, we do have more for you so you can understand the different types of policies. That just went over the different coverages. This is also going to be on your exam. So stay tuned for the next video where we cover the difference between the HO4, HO3, as well as the other HO policies. Give yourself a round of applause. Do this self-check for yourself to make sure that you thoroughly understand what you learned here today. If you need more quiz questions, click in the link below in the description. We do have some free practice questions available so you can test your skills. We also provide at Major Adjusters hands-on training, hands-on courses, and if you're in need of a career, don't forget we do recruit. You can find us on social media at any of these places, and if you want to email us, let me give you the best email to get the quickest response, which is faq-info@majoradjusters.com. Welcome to the claims adjusting community. You've chosen a very lucrative career. Look forward to seeing you next time.